Diwali. It has already passed, but Happy New Year for the new year. Okay, coming. Okay. So let's start with our series again. Okay. We are in BFM module C and D. Up till now we have covered ABM module A, B, C, D all. Plus BFM we have covered module A and B. All the objective questions we are covering so that it becomes easier for you. And remember, these similar questions you'll see it in the exam also. So follow this series till the end. Now what is module C and D? It's basically treasury management and balance sheet management. Okay. So follow this series till the end. Also follow this video till the end. Before going ahead, I would suggest download Adda 24/7 app on your mobile. In this app, you will be getting all these premium study material, current affairs, job alerts, daily quizzes. You can read it. Plus, importantly, I'll tell you, live video lectures means live classes you will be getting, plus the recorded videos of the same. Okay. Also, subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting all the updates. Do you know the latest update on CAIIB? Means the portion of May 23. We have prepared a separate video on that. Okay, so follow this. Yeah, see this. Presently, huge price drops are going on everywhere. Yeah, on all the products. Okay, go for that. I'll more on this later. Okay, this was a question which I had asked you earlier. So it was. The features of liquidity risk are. So what do you mean by liquidity risk? Liquidity means what? Well, the logic behind this is what? Suppose forget this banking system. What is your liquidity problem? What can be your liquidity problem? Liquidity problem can be you don't have the necessary funds to pay for the required things, right? Necessary things, right? So that is basically the liquidity problem. So in banking system also the same thing may arise. When it generally arises when you have a gap risk. Gap risk means what? Your assets and liabilities are number one of different maturity. Number two, the interest rate gap between the two is very less. In that case, you will definitely have a liquidity risk in your financial institution. Okay. So what are the features? It may arise from funding of long-term assets by short-term liabilities. Means what? 3 years loans. Okay, I've given a 3-year loan based on a deposit of 1 year. Means I have a deposit of 1 lakh over here for which is maturing after 1 year, and I give a loan based on this 1 lakh deposit for 3 years. Now definitely this will be a problem for me, because this person who has deposited 1 lakh with me will come to for withdrawal after 1 year, right, in that FD. But this loan I'll be getting repaid after 3 years. So where will I give these funds? From where will I give these funds to this guy? Isn't it? So this will definitely be a feature of the liquidity risk. Second, the liabilities are subject to refinance risk. Refinance means what? Refinance means whatever. Suppose if I'm having this FD, or let's say I bought some bond. See here, liquidity can be in terms of loans also, in terms of bonds also. Okay. Imagine you have bought a bond and which is maturing in next 1 month. So the problem with that bond is whether are you getting the same rate of interest which you are having with that bond presently. Suppose let's say the bond is presently at 6%. So are you having the same rate of interest again for 6%, or are you getting lesser? So that is known as refinance risk. Okay. Funding liquidity is an inability to obtain funds to meet the cash flow obligations. Quite logical. What is funding liquidity? Basically, see this, inability to obtain the funds means I don't have the funds to pay my necessary EMIs also, or the bank doesn't have the funds to pay the necessary depositors also. So that's basically funding liquidity risk, isn't it? So the features are all of these, A, B and C. Got it? Everyone clear? Let's move on to next question. Which of the following statements is correct? Okay. Now we have to find correct. Okay. Always check what is asked in the exam, whether it's correct or not correct. Okay. The funding risk may arise from the need to replace net outflows due to unanticipated withdrawals of deposits. So why can the funding risk arise? Because need to replace the net outflows. Suppose basically imagine your deposits are going. Everyone is withdrawing. So how will you fund the loans then? Because you have to give the loans for that, right? So if your deposits are constantly withdrawing, then you will definitely find the risk of funding, right? Okay, unanticipated withdrawal of deposit. This generally happens when you have a reputational risk. Okay, something bad comes about your bank in the newspapers, and everyone comes for the bank run, right? Withdrawing the deposit. Okay, second point. Time risk arises when performing assets turn into non-performing assets. Okay, means time risk arises when performing assets turn into non-performing assets. Means my standard assets have become an NPM. So here, firstly I'll get the answer from your side. Okay, call risk arises due to crystallization of contingent liabilities. Now what do you mean by this? Okay, crystallization of contingent liabilities. What are contingent liabilities? Contingent liabilities means, suppose let's say I give a guarantee. There are 3 to 4 types of contingent liabilities. Mainly, there can be many. Mainly are this bank guarantee LC. These are the two main, and availization of loans. So these are the main contingent liabilities. Crystallization means what? You have to pay it in that guarantee. That's called as crystallization. Means I give a guarantee on basis of somebody, and then the municipal corporation or the body to whom I have given that guarantee, that body comes to me for payment. Now that is called as crystallization. Okay. So what is the answer? A, B, C or D? All of these. Can all of these be the answer? Correct. The answer is all of these. Why? Because we want correct ones. This is correct. Call risk arises due to crystallization of contingent liabilities. That is correct. Funding risk may arise from the need to replace net outflows due to unanticipated withdrawals, because that will definitely give the rise to funding risk, right? Because if there are withdrawals of the deposits, you don't have funds, further funds, right? Time risk arises when NPA, means standard asset, turns into NPA. That's obvious. Means the calculations of mine on the ALM, asset liability part, will always be based on the logic that, or the axiom that, all my assets will be standard assets. If something turns into NPA, means I am not getting the funds back from my loans. So that's definitely will face the problems for giving the funds to the depositors, right? So all of these, got it? The features of interest rate risk are, what is the interest rate risk? Firstly, understand what is the interest rate risk. Interest rate risk means the asking interest rate. Asking means what? Imagine, let's say, I'll give you a simple example. If your bank is giving an FD of, let's say, 6%, okay, and imagine there is another bank just besides you, okay, a new branch which has opened, and it is giving an FD of, let's say, 8%. So the asking rate for this FD, for your FD, goes up now, because people will start asking, point at you that, see, that bank is giving 8%, you are giving 6%. So that is known as asking rate, okay, or interest rate. Okay. The features of interest rate risk are, so let me get the answer from you first. It's an exposure of the bank's financial condition to adverse movements in the interest rates. Means bank's financial condition to adverse movement. Basically, what is interest rate risk? It means adverse movements, isn't it? If the rate of interest, asking rate of interest, goes up, see here, in deposit it will go up, and in loans it will go down, isn't it? Logic. It has a direct effect on the net interest margin, isn't it? Net interest margin means what is NIM? NIM is the difference of rate of interest between your assets and liabilities. Your assets rate of interest should always be more, whereas compared to this liabilities. Then only you will earn this, then only you will have the salaries, isn't it? How to get the salaries? You get the money from the depositors and you give it to the loan holders, right? And the difference between them is your salary and other expenses, right? Okay. It may also affect the market value of the equity. Means the share value of that bank might be affected. Is it the same? Is it correct? Or is it D? A, B, C or D? Which one? Everyone fast. Quite simple, logical, isn't it? First one I gave you correct. Then second one, net interest margin, it is correct. Here, whenever you see two corrects, don't even look at the third one. Okay, go for all of these, because but obvious, if two are correct, the answer will be definitely all of these, isn't it? So the answer is correct, all of these. Got it? Which of the following is not a mismatch risk? Mismatch means what? What is mismatch? Mismatch is the difference in the maturities between the assets and liabilities. Okay, holding assets and liabilities with different maturities and amounts. Here, not a mismatch risk. We want not. Okay, so this holding assets and liabilities of different maturities, it is the mismatch risk, right? So A is a mismatch risk. This is true. I'll write it true or false. We want, what do we want in the question? We want false. Okay, false. What is the answer over here? This is true. Okay. Next, adverse movement in the interest rates. So not a mismatch risk. Okay, means interest rates are moving up or down in the reverse direction. Means is this related to basically mismatch? What is mismatch? Durations. Okay, and adverse movement in the interest rate means asking rate. Okay, I won't answer this right now. Let me get the answer from you. See, when the liability is repriced on the maturity date and this causes variation in the interest rates. So liability is repriced on the maturity date. Reprice. So repricing of this liability will definitely lead to what? It will definitely lead to repricing to this mismatch, right? So C will definitely be the answer in this. C will also be true. But what do I want? I want false, isn't it? Adverse movement in the interest rates. What is the adverse movement? The rate of interest, asking rate of interest goes up and down. Is this related to maturity? This is the rate of interest which the people are demanding. So the answer over here is false. This is false. Okay. So which of the following is not a mismatch risk? B is the answer. Got it, everyone? Clear? Because rate of interest rate is related to yield curve risk, basically. Remember this. Okay. It is not related to maturities. Okay. What is the yield curve risk then? Okay. Let's get see the options first. Firstly, what is yield curve risk? What do you understand by this? Okay, let me see if the answer is given over here. Yeah, many answers are there only. When two different instruments maturing at different time horizon for pricing assets and liabilities. Means two different instruments here. Generally, yield curve risk is compared with same rating bonds. Means what? Let's say the bond is having A plus security. Okay, rating. If this is the rating of bond, then the yield curve risk of all AA plus of various maturities, one is 6 months, second is 12 months, third is let's say 3 years, fourth is 10 years. Okay, so different maturities but all with the same rating, only they are compared. So that's known as yield curve risk. Okay, when two different instruments maturing at a different time horizon for pricing assets and liabilities. So it is this answer? What did I tell you? Different maturities, different time horizons are compared. So yield curve risk will definitely be a part of this. Okay, so A can be the feature. B, okay, I'll mark it over here. B, there may not be parallel movement in the interest rates of both the instruments. Not be parallel movement means what? It means that if the 6-month interest rate goes up by 1%, then the 10-year interest rate of the same rating security may not go by 1%. So that is known as parallel movement. This goes by 1, this may go by 2%, this may go by 0.5%. Okay, so that can also be a feature, right? Non-parallel movements in the yield curve may affect the net interest income. So can this affect it? Means non-parallel movements in the yield curve. What do you mean by this? See this. Non-parallel means this goes up by 2% and this goes up by 1%, or this comes down by 1%. So definitely there will be a gap. After all, see this. Whenever you have a 2% extra income and 1% negative income, so you'll have a netted income. So that will definitely affect this net interest income, right? So C can also be the answer. So that's why the correct answer is A, B and C, that is D. Got it? How many of you got this correct? Let me check. How many of you got this correct? Type yes if all of you felt that it was D. How many of you? Type fast. Let me check. Okay. Firstly, like this video. Everyone kindly like this video and share it in your various social media groups. WhatsApp, Facebook, so that others can also get the benefit, isn't it? See here, this is free, right? So even you must give it whenever something you have got it as free, you must distribute it with others also, so that others will also benefit from them, isn't it? Move on. Now this is your homework question. Which of the following statements is correct regarding the yield curve risk? Here we want correct. Okay, true one we want. Always check in the exam whether they are asking for true or false. Okay. When the interest rates are floating, banks may price assets and liabilities of different maturities such as T-bills, call money, MIBOR, etc. Okay, means whenever interest rates are floating, banks may price assets and liabilities on different maturity instruments, such as means banks can have a different benchmarks for interest rates. Okay, number one, that can be one option. So I'm not giving you the answer now, you will have to find the answer, and tomorrow I'll answer this. Okay, a bank needs to evaluate the movement in the yield curves and impact of the curve on the portfolio value and income. So bank needs to evaluate the impact on of the movement. So definitely means if the yield curve, what do you mean? I just told you the meaning of this yield curve or the interest rate, right? What is yield curve? The asking rate difference. Okay, so bank needs to evaluate what is the difference on that NIM, right? Okay, if a liability is raised through 91 days T-bills and used to fund an asset of 364 days, it would be a yield curve risk. Now this is something which you have to think. I know the answer, I can give you right now also, but I want you guys to think. Okay, so think over it and type the answer in the comment section. Let it be one line, two line, you type it in the comment section. Let me check how many of you are really answering it. Okay, this is a very important question, C part. Okay, and the D is all of these. So let me check how many of you give the correct answers. Okay, tomorrow I'll be giving you the same answer for this. Okay, so before going moving, I would suggest, see this, the batch which is coming up. See here, I'll just take you to Adda 24/7 live. Okay, in that we are having various schemes going on. Okay, I'll just show you those schemes, those all the schemes, as well as for these assets for these various exams also. See this, go to Adda 24/7, click on JAIIB and CAIIB. See this, you are having JAIIB, CAIIB Mahapack, you are seeing CAIIB 2023 also. So click on this Mahapack, because see this, what is the point in this Mahapack? The important part over here is, see, presently double validity scheme is going on. See, click on this CAIIB ka Mahapack, double validity scheme is going on. Now go on reading these details, you have ample time, right? Means all the important features you read it. Always I would suggest, whenever you sign on something, or you always go through the details, what are the advantages you are getting. 4+ batches of ABM, 3+ batches of BFM, 3+ batches of retail banking, means 6+ 6 months. Here the important part of this 6+ 6 month validity is, this 6 months will be for the old portion, next 6 months will be for the new portion. So you'll get a double benefit for this. So go for it immediately. Okay, and see what are the features. Live classes of more than 500+ hours, case study batches, highly experienced faculties, different subject expertise, special exam focused revision batches. So you are getting everything, isn't it? So when you are getting so many benefits, and look at the fees, 30,009, and you'll say, sir, very high fees. Okay, let's see, click on view offers. Now look at the offers, put the code Y432, just click on apply. Now look at this, see this, 80% off. My god, 30,099 has reduced to 6019, 80% off, and that also with double validity. So double dhamaka you are getting. Firstly, discount of 80%, and second, you are getting the double validity also, isn't it? So go for it. Once you clear this CAIIB, this 6,000 will be returned in what period? Right, payback period for this is what, hardly 6 to 7 months. Go for it. Okay, why am I stressing on this? Because see this, try to clear the exam in this December only. Why? Because see this, the March portion which is coming up, if you see the March portion, I've just given it over here. See this, presently you are having these two papers only, paper 1, paper 2, ABM, BFM, compulsory ones, isn't it? And specialization this retail, isn't it? Elective one. But the point over here is, in May 23 you will be having 4 papers, paper 1, 2, 3. What is 3? Look at this, advanced business and financial management, means this is more related to MBA, right? MBA PPM subject, those who might be have done this MBA, advanced business and financial management. Second, paper 4, legal, banking regulations and business laws. Now look at the topics, management process, advanced concepts of financial management, valuations and mergers, then emerging business solutions. And in legal, what are you getting? In legal you are getting this regulations and compliance, important acts and laws. Here again acts and laws and commercial laws. Now important part over here is, everyone please remember, look at this, as of now in your banking curriculum and in your banking working day, you are getting 2 subjects as a tough one for clearing the CAIIB. Then why are you going for this 4 one? 4, right? Clear it immediately. And also the electives, look at these electives. Presently you are having this retail. Now what are you having in May 23? Rural, HR, IT, central, and this risk. Many of us have not worked over here. We have worked in retail, right? So of course, when we give in that batch, we'll be definitely giving you all the details about this. So, but I would suggest why to go for the difficult ones. Clear this in December only. Join all the batches. Join all these double dhamaka packs. Okay, and there's a negative marking over there. Okay, so now I'll leave it to you. Get the homework done. Also tomorrow I'll be back with one more session. Okay, bye till then.